Now, Eli Lilly stocks are on the rise after the pharmaceutical company posted a new drug trial with promising results for weight loss. For more on it, we're joined by Art Hogan, Chief Marketing Strategist at B. Riley Wealth. Art, thanks as always for joining us.
Thanks so much for having me.
Your thoughts on Eli Lilly and this the weight loss drug they're talking about? Is there a reason for optimism?
It certainly is. The first of the several phase 3 trials, they've got 7 more that they're going to run through over the course of this the upcoming calendar year, is a new formulation. So Zepbound is a dual adjunct GLP-1 and GIP weight loss drug, and they've got that in injection form, and they're soon to be releasing a pill form. This would be a new approach to this. It would be a triple agent attack on both obesity, and the new twist to this would be relief of arthritic pain in the knee. So this is something that the GLP-1 components have not played into yet, and I think that it's very exciting. The first results of the first trial came out very positively. So both in tolerability and in end results, everyone that was in the trial had a BMI north of 40, and
Wow.
there was such good results that several of the people in the trial decided to cut it off there. So 24% of body weight loss was the average. So they're pretty excited about that. That's next year's business. I think the other piece of news that is hitting Lilly today is the fact that they're going to spend $6 billion to build a new Alabama manufacturing plant, which likely curries some favor for them in the current administration, bringing manufacturing to the U.S.
Yeah, how important is that they do something? We'll stay with that for a second, that bringing that plant there. What will that mean for them, do you think?
Well, certainly, onshoring any kind of pharmaceutical manufacturing is beneficial. We learned in the pandemic that we've offshored most of the pharmaceutical manufacturing, and that got to be a problem, especially with generics. So the more we can onshore manufacturing or nearshore manufacturing of pharmaceuticals will certainly keep us safer in terms of having the clean and available supply chains. But also in this administration, where they really like to see reshoring of manufacturing, it sort of helps you get a leg up on the competition. And Lilly's biggest competition is Novo Nordisk, and they certainly don't have any domestic U.S. manufacturing.
And now next year's news, as you were saying, they're going in a new direction with that, with combining the three. Is there dangers to this, that there could be a larger fail as well?
Well, that's interesting because they did not see that, and it's called the 3 Gs. So remember, Zepbound has 2 of those Gs already with GLP-1 and GIP. The third is actually proven effective in a different layer of the hunger component, and so far so good. So tolerability was very high. Their end results are very high, and obviously they have to go through a multitude of phase 3 trials to make sure the safety is there. But so far, so good. I certainly think they were quite impressed with the early results.
All right, we're going to do an about face and go from real people to real AI, if that's such a thing. Oracle, numbers weren't bad, but they were disappointing still.
Yeah, it's amazing. Oracle's kind of the poster child for the concerns over how much money our company's spending to get to that end goal of offering the large language model that will be the best in the world. And the difference between Oracle, which is a late entrance into the AI darlings race, and some of the early entrants like Alphabet and Microsoft, is that they are actually taking on corporate debt. They're having zero problems actually issuing that debt. But instead of having that massive CapEx spend come out of cash flows, they're actually the first to really layer into some significant debt. They put out $19 billion of debt before they reported the quarter, and that raises some questions. Will you be able to monetize this fast enough to actually have it make sense to have that much debt placed on your balance sheet? I would say the company's doing very well and has about $500 billion in RPOs over the course of the next 15 months, if they can get that executed. Most of that $300 billion is with OpenAI. But at this point in time, none of these companies can disappoint on the top, bottom line, or in guidance, and they just disappointed, unfortunately, on the top line.
And just kind of looking forward, bigger picture, what does that say about AI and tech right now?
Yeah, I'll tell you this. So I don't think it says a whole lot about AI in general. I think at the end of the day, we're certainly going to have winners and losers, and who's leading the pack has changed quite a bit from 3 years ago when ChatGPT was rolled out. Currently, Alphabet's Gemini is the leader, meaning it's probably the best of the large language models, but that can go back and forth a lot. I think you have to take a step back and say, well, how have the AI darlings done this year? And if you look at the Mag 7, there's 5 of the Mag 7 that aren't doing as well as the S&P 500. So that sort of irrational exuberance that we've seen for the last couple of years has really calmed down, and the market's got much more selective as to how they should allocate funds into the AI trade, and it's broadened out into other industries like the industrials and certainly utilities.
And there are opportunities, aren't there, in other places, in other sectors?
There certainly are, and I think there will continue to be other opportunities. So in the very beginning, you wanted to invest in the hardware companies. That was NVIDIA. They were selling to everybody, and you needed NVIDIA's chips. And then you wanted to start to see who's going to turn this into revenues, and that's where Meta and Apple recently, and certainly Alphabet and Microsoft are coming into play, and eventually OpenAI will let us know what they do. Further down that value chain, you have to start to look at the software companies that will be integral in benefiting from the adoption of artificial intelligence. We're in the early innings of all of this, but I would certainly say that the investor in artificial intelligence has gotten broader and certainly looking for other avenues to express that opinion.
And then even beyond that, though, I mean, I'm just looking at your notes here. 11 of the S&P 500 sectors, all of them are in positive territory for the year to date.
Yeah, and that was not the case last year. As a matter of fact, we've got 5 of the 11 that are doing as well or better than the index itself. Last year there was 2, and only 7 of the 11 were in positive territory on a year-to-date basis coming into this week. So we have a much broader investment in the market this year, which I think makes it a much healthier investment too, and less precarious and less dependent on the top 7 mega cap technology stocks. Nice
to have that choice, or does it make it harder to choose?
No, I don't think it does. I think being diversified has always paid off, and obviously you missed out on a bit if you weren't exposed to the artificial intelligence names. But I also would offer up that you'd want an S&P 500 making a new high like it did yesterday, and will likely continue to do into the first quarter of next year, if it's being driven by a broader set of sectors. And I certainly think that that's going to be the case. If you look at financials and healthcare, they've certainly picked up their head. Healthcare is outperforming the S&P 500 since the lows of November. If you look at small caps, the Russell 2000 outperforming the Dow and the S&P from the lows of September. So we're starting to see that differentiation and that broadening out. I just think that puts us in a healthier place, but reminds us why we want to be diversified.
Okay, we'll leave it on that note there. Art, always a pleasure. Thank you, sir.
Thank you.
Art Hogan, Chief Marketing Strategist for B. Riley Wealth.